So when it comes to day trading, everyone is looking for that holy grail indicator or entry signal. Everyone wants to know what's that next thing, what's that next indicator, what's that next entry signal that's going to guarantee that I'm going to win 100% of the time. Guys, that does not exist. In fact, the secret tool, that secret sauce that you're looking for that's going to help you find profitability faster is actually not a secret at all. It's actually a very basic concept that is often overlooked and not understood and studied enough. Understanding this concept will open your eyes to a whole new world when it comes to technical analysis. And that concept, that secret sauce is called market structure. Yeah. These videos are meant for educational purposes only. Any trades taken in the financial markets are under your own discretion. The information taught should be demoed and only taken to live accounts under your own responsibility. E is profitable, will not be held liable for anything you do with the information presented. Market structure, by definition, is the behavior, condition, and current flow of the market. It is a framework or structure by which a current market is trading. So through market structure, you can determine whether or not the market is bearish, bullish, or consolidating. Those are the three types of market structures, right? And we're going to go over basic concepts, and then we'll go into more intermediate and advanced understanding within regards to market structure. So to start, what is a bullish market structure? A bullish market structure is when price is making higher highs and higher lows. So if you look at the screen in front of you and the example that I have, you can see where as the market is moving high, it is creating higher highs, which validates that the market is bullish, and it's creating higher lows, letting you know that the market is bullish, right? It does not want to go down, like it wants to continue with the bullish momentum. The next structure is a bearish structure, which is the opposite, is when price is making lower lows and lower highs. Through technical analysis, you can confirm that we are in a bearish market based off of the price action that you're seeing. And then last but not least, you have a consolidating market. That is when the market is moving sideways. You're going to see that it's moving within a range. So it's not going above a certain high and it's not going below a certain low. That is it. These are the only three ways that the market is going to move. It's either going to move up, going to move down, or it's going to move sideways, right? So what we'll do then is we'll go into this topic a little bit further, where you can see that within a structure, there are other structures happening in lower time frames, and we'll touch on that here in a little bit. All right, so let's go straight to the drawing board, and then we'll look at some charts. All right, so if we're looking at a bullish market, right, you're gonna notice that there's going to be impulses, there will be retracements, and there'll be impulses, there'll be retracements, there'll be impulses, retracements, impulses. So as long as the market is making higher highs and higher lows, right? These are the lows. As long as you see that the market is creating higher lows, then one can assume that it is a bullish market. And then at that point, what you're doing is you're looking for opportunities to get in and ride that wave higher. When the market moves up, you can look at this like this is an expensive area. When the market retraces, you can look at this as a discounted area. So with that in mind, where would you look for entries if you're buying? If you're buying, you don't want to buy when the market is peaking. You want to buy when it retraces, right? Because the market is at a discount, right? So you would buy around this area. You would allow the market to ride higher, where you could sell right, at a premium and make the difference. So you're buying at a discount. Let's say if you got in this position around this area, and then you would ride the wave higher, and then you would close out your position, meaning that you made the profits, you know, from this level to the next. So in short, that is price action, and that is how you determine whether the market is bullish or bearish, right? The same concept. If it was bearish, it would show on the way down. If you're shorting the position, that means you're looking for opportunities to sell when the market is at a discount, right? In this case, when it retraces up, you would look to short the position, ride the wave down. Retraces up, you look for position to short, ride the wave down, and continue with that concept. All right, so when we're looking at market structure, what we have to keep in mind is that the market has structure in every time frame, right? And what is more prominent is the higher time frame. So let's imagine that this was a daily structure, right? If this was a daily structure, we know that the market is bullish. Well, within the daily structure, in lower time frames, let's say in a 15-minute time frame, and let me change this color so we can see this with clarity. All right, so let's imagine that this is the hour, the 1 hour. This is the 1 hour structure, right? So the black is a 1 hour structure, we know that. And then the orange, let's imagine that the orange is a 15-minute structure. All right. So you'll notice that within a higher structure, in lower time frames, the market is going to move and is going to have its own structures, right? So the market might do this. So at this point, the market flipped bearish, right? So we're bearish because it's making lower lows and lower highs. And let's say around here, it decides to flip bullish again. And then we're bearish again, bullish, bearish, bullish again. All right. So that's why I say the market is fractal, right? So in a higher time frame, we're still bullish. In a lower time frame, when the market got to this point, it went from bullish and then it flipped to bearish. So if you would be trading a lower time frame, let's say if you were trading the 15-minute, when the market makes this shift here, right, you would then look for shorts. And then you would wait until the market flips bullish again, and then you can start looking for buys. And that goes even further, right? So we know that the black is the hourly, the orange is the 15-minute. So within the 15-minute, let's say if you went to the 1 minute time frame, and we'll change this to a different colors to represent that, you will notice that you're going to have bullish momentum, you know, you're going to have bearish momentum within that same area, you know, and then bullish. So within a 15-minute, you will have bullish, bearish, bullish, bearish. Within the hour, you're going to have the 15-minute bullish, then the 15-minute bearish. So it just depends on how low you go in time frame. I mean, you can go all the way down to the seconds. All right. So I say all of that to say that you have to always keep in mind that depending on what time frame you're trading and what price action is showing you is where you would determine whether you're bullish or bearish. So the beauty about trading is that someone can be bullish and someone can be bearish and they both make money, right? Because let's just say if this was the hourly time frame, and I'm bullish, I'm going to wait for opportunities at, where the price is at a discount for me to buy and get in, right? Whereas if someone is trading at a lower time frame, they could be bearish here when the market starts to retrace, and they can sell here and make money and then close their position, be a buyer, be a seller, be a buyer. And then within that leg, there are smaller, lower time frame shifts that are happening within the market. So, that's something that you always want to keep in mind as well. The most important thing that I want you to take away out of this is that you always want to keep in mind higher time frame structure, right? Because if you're not paying attention to what's happening on the higher time frame, and let's say that you were trading the 15-minute or the 5-minute, and you think that the market is bullish, right? And you're always looking for buys, what can happen is that realistically the market in a higher time frame is bearish, and that momentum that you were trading on a lower time frame was actually a retracement before the market makes a lower leg, right? So the black would be the hourly, the green would be the 15-minute or the 5-minute. So you always want to trade with a higher time frame in mind. You always want to keep in mind as well that the greater force flows with the higher time frame. So, you don't want to get stuck looking for buys if a higher time frame momentum is bearish, because when this next impulsive move happens where the market wants to make a lower low, you can get caught with your pants down. You can get caught with buys, and the market is just going to push with more strength lower, and your stop loss is going to get hit. So as a beginner trader, you want to try to stick to trading with the higher time frame. You want to look for opportunities that flow with higher time frame momentum. So if the higher time frame is showing bearish market structure, you want to look for sell opportunities in lower time frames, but still aligned with that higher time frame directional bias. As you get better with trading, you can look for opportunities with buys on a lower time frame, and it won't affect you because how to handle it with risk management, and that the market is going to continue that higher time frame directional bias, but there are still opportunities in lower time frames. All right, so let's look at now an example as to when the market flips from bullish to bearish. So if we're looking at the market and the market is making higher highs and higher lows, the way you know when the market has shifted from bullish to bearish is when there is a break of structure, right? So what you're waiting essentially is for the market to take out the last low that was created before the next leg up, right? So as long as we're creating higher lows, we know that the market is bullish. The moment the market trades lower than the previous low before that leg up was created, we can say that the market is now looking for a possible bearish move. And the reason why I say possible is because there are times where the market is going to trade below the previous low, but then it'll continue its course and make a higher high. And the reason why that happens is to take out liquidity, which is a more intermediate and advanced topic, something that we'll discuss in other videos. All right, so for now, just understand that as long as these lows that are being created are protected, the market is showing you bullish momentum. The moment these lows are violated, then we can start looking for bearish opportunities. And for double confirmation, you want to wait for the second leg down to be broken, right? So once the market breaks that lower low once, retraces, and then breaks another low twice, at that point, there's a high probability that the market is going to continue bearish, and you can start now looking for sells. All right. So you always want to look at these last lows, like if they are steps, right? So as long as these steps aren't violated, then you know that we're still bullish. The moment this step was violated, now you know that we're now looking at bearish momentum, right? So then you would be looking for sells. All right, guys. So again, to recap, as long as the market is showing you price action that reflects bullish momentum, you should be looking for buys. The moment the market starts to show you bearish momentum, where it's making lower lows and lower highs, you should be looking for sells. That is market structure. Market structure is very important. It does not matter if you know about imbalances, about order blocks, various different topics that we're going to go into in later videos, but it doesn't matter how good you get with that. If you are not paying attention to market structure, if you don't know what is happening with the market, you are going to lose trades. You're going to be on the wrong side of the trades, and you're not going to take advantage of these strong impulses that you would normally get when you're following and when you're on the right side of the market. All right. So if there's anything I want you guys to take with you, is that you have to study price action. You have to study market structure, begin from a higher time frame and work your way down so that you know exactly what is happening in the market, and you know where you are and where the market is going next. All right, guys. So we're looking at NAS 100, and we're going to do a very simple exercise. We're going to mark up the chart, and the goal is to see if we can figure out what the market structure is. All right. So if we're looking at this, we can start on the daily, right? We're going to go ahead and mark this on the daily. Right. So we want to look for lowest points and highest points, and that's how we're going to determine structure. Actually, let's go a little bit higher. We'll go from here. So on the weekly, this is what the market is giving us, right? So you're marking it from a low point to a high point. From a low point, you notice that was the retracement. And then did it break the low? It didn't. So because it didn't break the low, you can assume the market is going to continue bullish. This is another high point. This is another retracement. This is a discount. Did this retracement go below the previous low that created that next leg up? It did not. And because it did not, you can assume that we're going to continue bullish. Made another leg up. This is the retracement. It attempted to make another leg up, but it didn't. You notice where it stopped right there. Had the market continued further, then you can assume that we're going to continue bullish. But because it stopped right there, that's where you want to pay attention and see what the market is doing. What did the market do next? It broke this previous low, and it broke this one. Now, this is something that I want you to pay attention to, what I'm about to say. When the market broke, and let me change this. When the market broke this low here, let's say if the market would have only broken this low. If the market would have only broken that low, you still don't know if we're going to be bearish, because the market at this point could have done this to take out the liquidity that's sitting here and then made a new high. So when the market takes out this low here, you still have to be cautious. It's not until the market breaks this low that it validates bearish momentum, right? And one of the reasons why is, again, as I said before, the low that created the next break of structure is the one that counts. This one doesn't count because this one didn't cause another break of structure. All this one did was let the market stop here, right? So there's no force behind it. So you have to wait for this area here to break, right? Once this area here broke, this break of structure, once this area here broke, that was your confirmation that the market flipped bearish. Okay, so let's continue. We see that the market broke that structure, and then let's keep marking it. So from there, it created a retracement, right? So if you were going short, this would be a perfect opportunity to go short, and then it made its next leg down. So as you can see, this is happening on a higher time frame. So if you're analyzing this from a higher time frame, you know that the greater momentum right now is in shorts. So you don't want to get too involved buying right now, because and thinking that the market switched to bullish when in reality we're still bearish on a higher time frame. So as we go to a lower time frame, so for example, we're looking at the daily, right? If we're looking at the daily, I know that I'm not going to, just because, for example, in this area on the daily, we flipped bullish, right? Because we broke structure and we're making higher. Just because we're making higher price action on the daily doesn't mean that as a macro market, we're bullish. We're not bullish until this high is broken. That high did not break. You notice what we did is we then flipped bearish on the daily, right? So we're here. So let's imagine that the market flips bullish again on the daily. That's only temporary. It's not until the market breaks the peak, which is right here. Until that happens, I still have a bearish bias on the market. Now, once the market does this and it goes above this, then we can say with confidence that we're now bullish. All right. So this was the daily. You see the transitions that are happening, right? So let's go down even further. All right. So we're right here. This is a perfect example of the different shifts that are happening within the market. So higher time frame, we're bearish. The market on a lower time frame, if you notice, right, was making lower lows and lower highs, right? Lower lows and lower highs. We're bearish. What happened right here? Once this move happened, that is telling you that the market is now bullish, but again, on a lower time frame. So if you're trading a lower time frame, then you can flip your bias to buys, right? And you can get in buys and ride this as much as you can. But you have to be careful because the greater force comes from the higher time frame. So you know that at any moment the market can shift bearish, and if you're not managing your position correctly, you know, it can hit your stop loss, right? So we're looking at the 4-hour, and the market is fractal. So the lower time frame you go, the more you can see where there's more shifts and more shifts and more shifts, you know. So you know, this is the 15-minute. So within the 15-minute itself, you know, you have bullish momentum, bearish momentum. You have all this going on. So that's why you have to keep in mind what's happening on the higher time frame. And then based off of that, then that'll help you determine what direction you should go with your bias. All right. So that's just very basic concept. It's something that I encourage you to practice. Go back through your charts, just mark them up. You know, mark up the structure, and then pay attention to the impulsive moves and where they're happening and why they're happening. There's a lot more to this topic that belong more to intermediate and advanced traders, and we'll definitely touch on that later on. But I wanted to, at the very least, give those that are starting the knowledge needed to hopefully to understand what market structure is. And as simple as this may seem, a lot of traders get this wrong. Market structure is one of those things that confuses a lot of traders, you know, because they don't know if the market flipped bullish and then suddenly it turns bearish, and they're confused by that and they don't know why. And that's why we have to really and truly understand what market structure is, what is happening, where are you today in the bigger scheme of things, you know. All right, so I hope this video helped. That was a very basic explanation of market structure. As far as consolidation, as I stated in the beginning, consolidation is when the market moves sideways. There is not much that I can say about that, except that it's a range that the market is stuck in. You know, if the market was stuck in a range, in this example, the range would be this high and the range would be this low. So the market is stuck in this range. Price action is moving sideways. You know, you don't know if it's bullish or bearish truly. Now that's not to say that you can't trade this. There are opportunities to trade this in lower time frames and whatnot, but this is what consolidation looks like. All right. So again, I hope this helps. If you guys have any questions, concerns, suggestions, go ahead and comment. You can send me a message and I will try to get those answered. Please don't forget to subscribe, to click on the notification button. Again, this is a very basic video. This is for beginners. This is not for intermediate or advanced traders. We will be discussing market structure in more advanced ways, and those videos are coming soon. So I just wanted to get those that are starting their feet wet so they can at the very least get that basic knowledge they need to begin their trading journey. All right, guys. So thank you for visiting the channel. I'm your host, E is Profitable, and I'll catch you on the next one.